All right, we're live. Okay, guys, this is the very first episode of the Real Estate Lunchbox. We're going to talk a little bit about where I got that name from, Real Estate Lunchbox. But I really wanted to start this very first episode with the guy who brought me to the brokerage that I'm in right now. Okay. And really, he mentioned it to someone, James Massey over at EXP. And James called me. But Trent, I consider him to be like a brother in the space, man, simply because of what he's doing. So I want to introduce you. This is Trent Dunn. Trenton, go ahead and take it, man. Tell me a little bit. Let's tell everybody a little bit about yourself, a little bit about you.
Yep. So, born and raised here in Atlanta. Went to school for electrical engineering. I studied electrical engineering. Didn't want to get into the field, so I got into real estate. Started just investing on the side around 2003. I learned a lot from a lot of those, the late night television telemarketers or the marketers on television trying to sell you real estate courses. So I ended up, I believe it was Carlton Sheiks or something like that, and got the course and started learning about flipping homes and using your credit to be able to get loans to flip houses. And at the time I had good credit, but I didn't have any real income, and they were doing no doc loans back in the day. So you didn't have to have any kind of documentation. You didn't have to show any kind of, proof of income or tax returns. So I was able to get some loans, and I started investing that way back then. And then, a lot of those loans were adjustable rate mortgages, which people are actually starting to do now. They're getting these 3-year and 5-year arms. And that really messed me up once the interest rates shot up around 2008, 2009, when the market, had a bubble burst. So, I experienced the downturn. So I was just investing and experienced the downturn during that time frame. And I lost some investment properties that I had to foreclosure, and I had to kind of reboot and start back over. So around 2010, I was able to save up a little bit, and I was able to get back into the game and start finding some deals. So I found some great deals around that time frame because houses were selling for so cheap. So one of my first deals that I found was a home that was selling for, like, I believe, $15,000. I bought it. It was a 2000 built. I think it was built in 2001 or early 2000 built. Great looking house. And I bought it cash and sold it within a week and made $5,000. I did a small markup. I made a little money, and I was hooked ever since.
You were hooked ever. And Trent, you rushing. We're gonna talk more about that. Okay, because we got a lot of people saying that the market that we've got now is very similar to the market in 2008, 2006. I came in 2006. We're going to get to that because I definitely want to hear your perspective on this. A lot of people, I think Trent, you're being very, for everybody out there, Trent is being very humble. This gentleman takes on multiple portfolios. I mean, Trent, what is the largest portfolio you've ever transacted? What set of homes at one time?
Well, I've been doing. At certain moments, I probably worked like 3 portfolios at once, which is probably about 300 homes
in one portfolio.
No, well, at one, multiple portfolios, and I'm working all of them at the same time. Probably about 300 or so homes. So the company I have now, so fast forward from my story. 2010, I started doing business with my brother, Trent Dunn. So he came from more of a corporate background, had a lot of experience. He's a civil engineer, and has a lot of experience working with governments and working with, working in more of that kind of structured realm. So we came together to be partners in 2010. And ever since then, we've been doing we created a fully vertically integrated real estate company. So we'll do.
Explain that to me, because I'm very, I'm a simple man. Explain it
Yeah.
to everybody out here. What do you mean by vertically integrated company?
Yep. So it's kind of a self-feeding loop of business that we create. So if you imagine like a circle, we start doing acquisitions. So we'll acquire or buy real estate, and then we'll manage the real estate. So we'll do self-management of it, meaning if we're preparing it for sale or if we're going to be renting the property, and then we do sales. So we have a acquisition kind of entity where we buy properties and we have capital, and we work with other equity sources to buy. And then we have our own property management company that we've created, where we have a staff of property managers, maintenance technicians, and assistants to kind of help cater to our tenants. And then we have a sales team, a sales department, where pretty much I'm the managing broker, where I will kind of facilitate the sale of either single family or multifamily assets or portfolios or whatever we're working with. So in that sense, we're able to, create our own inventory we do new construction as well. So we might build some properties and be able to sell them, manage them, and sell them. So we don't have to use outside people or outside resources to kind of do that full life cycle of buying, managing, and selling. We can kind of do all that in-house. So that's what I mean by vertical integration. We don't have to use outside brokers. We don't have to use outside salespeople. We don't have to use outside capital.
Everything is in-house. Everything is in-house. And that's a big thing, because capital, we got a lot of investors, agents that are investors. They're going and looking for capital. And even right now, we're going to talk about that in a second. I know you're out there in the field. If you can't tell, Trent is out there. He's actually looking at property. He's actually viewing property that comes to him, looking for pieces for a portfolio. So this guy is actually active in the market. This is not something that we're, hypothetical. He's really sitting down there. He called me, said, "Hey, can we push it back a half an hour for you, Trent?" Of course. Of course. Okay, so we talk about cash, finding capital and finding cash. Man, I know I look for capital based off of previous investors, people I've worked with, people that just approach me, "Hey, Leon, I want to do this, da 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 da," and I show them where we can fit to make their money better. I mean, is that a big thing right now? Should investors be looking for outside capital, or do you think these hard money lenders, are we going to lose some of them? Some of them are going to stay. It's a lot of stuff that's taking place. These rates are. Yeah. Where are you getting your capital from? Actually, don't tell me his name. Actually, tell me his name. No, but don't tell me his name. Just tell me, what are some cool ways that you found capital that's helped you to be able to build this system?
Yeah. Well, capital is definitely becoming more expensive. I mean, interest rates are shooting up even more so for investment capital. Like if you're looking for, like you mentioned, hard money loans or construction loans, rehab loans, the interest rates are higher than residential loans. If you got like something where you're personally guaranteeing it as a owner occupant or something along those lines. If you're an investor, the interest rates are going to be considerably higher, which then makes your cost higher for if you're renting property. It makes your overhead and your overall operating costs, and your debt service costs higher. So your profits are lower. And for some people that might just try to get into the game, and you go and get a adjustable rate mortgage for your investment property, and things turn around on you where the interest rates pop up, that can end up sending you into the red, possibly.
Into the red.
So you might end up losing the property. So it's just being careful. A lot of investors are kind of just holding back right now, especially smaller investors. They're just kind of standing on the sideline and trying to see like, okay, where are things going with interest rates before we start buying? What we're doing right now, we're fortunate enough to have some cash to be able to buy and not have to, consider interest rates if we're in and out of a deal fairly quickly. If it's something that's going to take a little bit longer or something we're going to keep as a long-term rental, then we do look for some other sources. We work with lenders like Lima One Capital, Lending One Capital. These are lenders that kind of cater to. There's also one Angel Oak. They cater to investors. They try to have products that can fit your investment needs, but you're
So
still going to
you
be taking some higher interest rates.
so you're working with both. You've got cash backers too, right? And
Yeah,
then you've got
exactly.
and you've got cash backers. So you've got cash backers, and hard money lenders that you can
well,
go
not
to,
necessarily hard money, but
or
yeah,
private lenders. I mean, I guess when they got to do an appraisal, I kind of call them a hard money person. But these guys, some of them don't have to. I know everybody has different rules and setup, but you've got variety. So I guess your recommendation in approaching is diversify where you're getting your money from, basically, right?
Sure.
You can't be getting it from one source.
Right. And if you don't have personal cash, then it's like tap into somebody who might, so the people that have cash usually don't have the time. And the people that have the time,
Time.
have cash.
That's true.
That's where you can find strategic partnerships. And as long as you're good at what you do and you know what you're doing, it could be a good match for someone that has capital and they're saying, yeah, you found a great deal, you know how to work it, you know how to invest the money, then, that could be your financial source there. And that's usually how most people start. And that's how I started, just working with other friends and family in order to have money to do certain deals, investment deals, if you're looking to do them. And then as you kind of build that reputation and build a record of success, more people will want to give you money. Other people
That's true.
just know your network and circle. And then you can start tapping into potential. As you do larger deals, you can tap into institutional equity, which would be something where they would be able to put up most of or all of the equity needed for any particular deal, and then you can go chase down some debt that makes sense interest rate wise.
To actually make it happen. You mentioned about your brother. That's interesting. We got a lot of people I know that are solo agents out there, or solo investors. They're typically out there. How does it work with your brother and you? I mean, I've never had a pleasure of meeting him. I've heard you speak so many high regarding things. You hold your brother in high regard. How does that chemistry work where you guys, because you guys are running a pretty complicated system, how does that work with you guys? Do you guys like, I want to do it my way? No, we gonna do it your way. I mean, how does that work? You got that flow?
And it took a lot of time, man, to be honest. Like it's just like any relationship you have with somebody. And we learned each other over again, even getting closer as being brothers. We never worked together. And it's different when you work with family or even just working with a business partner. You have to be able to understand your strengths and your weaknesses. And then you have to know, if somebody's better at doing something, that doesn't mean that makes you bad or makes you incapable. Is you saying that I'm not the best at doing something and identifying what somebody else's strengths are. So you can do your, stay in your particular lane and you're looking at the greater good. It's really about understanding when you go into partnerships, it's about the bigger goal and bigger picture and not just like your own personal
thing you want to do.
Ego. Yeah, you can't let ego get in the way. You got to look at the bigger picture. You got to look at the end goal and saying like, if everybody stays in their lane, and you do what you're best at, then you'll have overall success, success.
What would you say your brother's best at?
So he's very detail oriented. So every partnership, I believe, you need somebody that's more of a creative mind, a more of a free thinker. And then you have to have somebody that's very detail oriented. You have to have that person, even if you have to hire that person. Preferably if you have a partner that's detail oriented, like that is a match. That's a great match. And a lot of times entrepreneurs, they're just everywhere, but when you have somebody that pays attention to the details, that is key. And that's what he's good at. So very detail oriented. He understands corporate structure and systems, which he brought to the table as well. Cause I'm an entrepreneur. I've never worked corporate. So
you've never worked a corporate job before?
I never worked a corporate job. So
you mind if I ask right now, how old are you?
I'm 43.
Dang, 43 years old and you've never worked a corporate job.
Yeah.
And I say that because I started corporate, went real estate, went back to corporate, and it takes a lot of discipline to actually be independent of corporate, be very successful, which I know that you are, and to do what you do. And it sounds like you're more like, would you say you're more the creative, free thinker, and he's more the detailed person in doing it. So his range will bring you back and say, hey, we got to look at these numbers. And then you'll say, man, we looking at numbers too much. We got to go. That's basically it.
It's the balance, because
it's the balance.
Because the corporate mindset is like conservative structure, safety net with salary, all those things. And my mindset has always been take some risk, take a chance, try new things, get out there and let's diversify and but you have to have the balance. So what I do, I'll bring new ideas to the table. And then what he does is play the devil's advocate, and he'll poke holes in it and be like, no, this won't work because of this. And then I say, okay, well, what can we do to make it work?
You need somebody like that. I think everybody needs somebody like that. I've seen the investors that are overly positive and like, yeah, it'll work, blah, blah, blah. And let's be for real. It ain't gonna work. You know what I'm saying? Because nobody criticized what they were actually going out to do. And they were not looking. They thought everything was positive. Oh, it always works. And I think you've had your successes and you've had your failures too. I'm gonna put you on. What do you think? What was? Give me a deal that you felt like, man, shoot, you kind of lost that. Because we all have those deals. I know, because people get on podcasts, we get on these recordings. We like to talk about all the wins. Tell me one time you felt like, or dollar amount, say, hey, I lost it. I lost in this deal, but I learned something from it.
Yeah. I mean, it was early. I learned and failed early. Fail early and fail fast. I always tell people that. But the key thing with your failures is you got to learn something from it. Like if you're not learning from your failures, you're going to keep repeating them. So my failures were back during the market crash, the first market crash, like 2008 to 2010. I learned a lot. That was a big learning lesson. I mean, honestly, I had like 2 or 3 foreclosures. I filed bankruptcy. You do that, you're gonna learn that lesson for a good 7 years. That's a 7-year lesson.
That's a 7-year lesson right there. You're like, it stuck with you. And so you were on the sidelines in that 7. You were still doing deals, but not at the capacity you felt like you could have done.
That's right. So that taught me, okay, now I don't have the ability to leverage my credit. Now I don't have the ability to, leverage other outside resources because I just didn't have them.
Yeah.
You know what I'm saying? So now
let's get creative.
Okay, what do I need to do to get back to that position to be able to do this? So during that 7 years, that's when I'm like, okay, I got to reestablish my credit. I have to make sure I start filing my tax return. I never filed my taxes like I should have and reported good income.
There's a lot of us that haven't done that. We had to go back and make some changes, report some good income, and just,
I was all about write-off.
Write off,
deduct. So it looks like I don't make any money. I don't pay any taxes. And that's usually the mindset of an entrepreneur. I want to keep as much of my money as possible. You're not paying taxes every time you get paid a commission or every time you get money. You're not paying your taxes, or you're not setting it aside. Yeah. So when tax time comes, you're like, oh my God, I got a $30,000 tax bill.
I got to close some deals. I got to find some way to pay it.
so then you start writing off stuff. And as you write off stuff, people don't realize it makes you unbankable. So now when you turn your tax return over to a lender, they're looking at your tax return and it says, okay, I see you made this much, but you only have a adjusted gross income of this because you had so many deductions. So now it looks like you didn't make any money. So now they can't give you certain loans because you don't have the income to back it, to guarantee it. So it's important to, show more income, be able to have good credit and have good tax returns. So you're painting that picture that lenders want to see. If you're not able to leverage debt, you're not going to reach certain levels of success. Certain people say, I want to be debt free. I want to, like, there's good debt and there's bad debt. Like you have to learn how to leverage good debt and be able to grow and stretch your money out further. When I'm only putting down 10 or 20%, even 30% on a property, I'm not putting up 100%. Like some people take pride in saying, I bought it all cash. I don't have debt. It's like, that's dumb. It's like, you don't have any debt, meaning you're not leveraging someone else's money. You can leverage someone else's money, put up the very minimal amount of your own money, and then be able to cash flow and actually have that debt serviced by a tenant or a renter. It's like, that is how you build and grow.
And grow. So recapping, right? Partnership with your brother. You You experienced the lows of the market, 2008, filed bankruptcy, came back swinging, putting together support, I would say, cash and financing from various sources. That's a lot of creative thinking. A lot of people don't understand coming in how to be creative, ethically creative with that too, you know, and you're doing a great job in doing that. Now we come into 2022, 2020, go to 2021, 2022. Where do you see this? I mean, this market, you've seen the bad. You've seen that. What do you think about this current market? Does it bear any resemblance to 2006, 2007?
It does, but it's different. You know, it's very different. And there's key things that people got to realize of why it's different. You know, so we saw the peak of the market probably around July. You know, this past July. That's probably the peak. And then we started seeing things coming down from there. So typically, if you look at a 50-year trend line in like home appreciation and how the home values are going up, it's normally like maybe a 5 to 7% increase over certain years, and you see a correction. But you know, around that pandemic time, we saw a 15-20% increase in home value.
50, yeah.
Which is insane. So now when we're seeing things coming back down and correcting, it seems like it's crashing, but that's not necessarily what's happening. You know, it's not crashing, it's correcting. So it is still and with the interest rates is making a lot of people stand on the sidelines, you know, so then it looks like, okay, there's a lot more inventory, not necessarily new inventory, it's just available inventory that's there. And then you see a lot of buyers. There's still people looking for homes, but there people are probably trying to be in a lower price range because of higher interest rates. It reduces their buying power. So that's what we're seeing, you know, in this effect of those things. Not necessarily saying there's a crash because of interest, because of mortgages. Like 2008 was mortgages. Those were bad mortgages. People that could not afford to pay things were getting loans. And then the interest rates changed drastically to the point where it's like it turned people upside down, which would happen to me, you know. So that's not necessarily what's happening this go around.
Yeah. So this go around, our last go around was the real estate market tanking, taking the stock market with it. What do you feel? There's a connection between the real estate market and the stock market right about now? Do you? Because when I look at it, I'm like, I see what's happening in the stock market, the adjustment, the crash. That's definitely necessary. Tech stocks, all those other things, over leveraged, a lot of that. Now we're in the real estate market. Do you feel like we're kind of getting a little bit of heat because of the stock market? And can you see that?
Yeah, I mean, you're just talking about the overall sentiment of buyers and people. You know, it's just how do people feel, right? How
do people feel?
That's just the fundamentals of like, how do people feel? So right now, people are very timid, and they're seeing a lot of their investments go down in value. You know, in the stock market. Like if you have a 401k, if you have a retirement account, IRA, if you have just a money market account or whatever you have, you know, you're seeing the value go down, and it's scary. So at that point, you're saying, okay, maybe I just need to stop. Let me just see where things are going, right? So when people are doing that and not continuously investing into the stock market as of right now, is the same thing with the real estate market. Everybody's kind of like, hold on, let me just wait and see where things are headed. From investors to regular retail home buyers, they're just standing on the sideline. Let's see where things go. I mean, I have a lot of tenants right now. They're willing to pay more. They're willing to pay higher rent. And that's the interesting correlation between the residential retail market and the rental market, you know, because a lot of people are going into the rental market, which is not being affected as much as people in the retail market, buying market, because those people are saying that can afford it. They're saying, I'd rather just rent for a while. Let me stand on the sideline and rent. And I'm actually willing to pay more in rent because they have the intention of saying, I'm going to rent for a year or 2 years, and then I'm going to get back into the buying market. So these are people that make good incomes. These are people that have good credit. They have the ability to buy, but they're intentionally choosing not to buy. They're saying, I'm going to go rent. So now they might be willing to pay more in rent and say like, okay, let me ride this out. And then later I'll get back into the market to buy when they feel like the time is right and they feel more comfortable with what they're getting for their money and the interest rates.
So what you're saying, can we now, which I don't think a lot of people are really seeing this, I'm projecting that with these higher interest rates, we're going to also have higher rental rates, because now you only got but so many properties you can rent. Unless you bring more inventory on the market for renters, you now create a demand, and they will pay more because they can't pay more to buy a house. I'm seeing a rise in rental amounts because you got a higher interest rate. And then some people are going to say, hey, heck, if I'm paying this much in rent, I might as well buy a house. And the system cycle goes back to where that adjustment goes back to where it was before. So do you feel like rentals for us investors that are out here, do you feel like we're going to see an explosion in our rentals?
As far as the rates go,
as far as our rental rates, what renters are paying monthly for a piece of property?
Oh yeah, for sure. I mean, I've seen a major increase in our portfolio. I mean, we've had rents go up drastically, but we're just aligning rents with market rent. I mean, it's just you just got to follow the market, and the market is going up because demand is higher. You know, a lot more people are entering the market. I mean, you got to think about the new generation of young people that are leaving their parents' homes, and a lot of younger people, they're not interested in buying. You know, They don't have the down payment cash. They don't value home ownership as much as other generations. So yeah, there's more people entering the rental market every year, and at the same time, those same people can't afford to buy. I mean, you got to think about them having the cash for a 5 or 10% down payment, them having the proper credit, and them having the historical income, especially because now you're seeing a lot of people that aren't having W-2 jobs. They're 1099 contractors. They're gig workers. They have money coming from multiple sources.
That's true.
That won't necessarily qualify you for a loan. You have to have consistent income sources, you know, over consistent years, at least 2 years from the same income source in order to qualify for a certain home loan. So, you know, it just makes it harder. So they're forced to rent. And when they're forced to rent, more people in the rental market. So now, you know, rents go up. So
I got this article up here, CNBC News. We've seen the news trashing the real estate market. Mortgage applications plummet 14% as higher interest rates. And I mean, the hurricane really, man, they did a lot of damage down there. If you're going to be in Florida market right now, it's sad to say, but if you're going to be doing anything in Florida, it's going to be a lot of opportunity, I feel, in Florida. You know, what's your take on that? Do you feel higher rates, tight supply, economic uncertainty? Here's what's happening with the market. I'm going to tell you this. One thing I noticed, and this is just me, one thing I noticed is that when the market is great, everybody wants to be an investor. But when the market is challenged and nobody wants, I'm getting out of real estate. I knew that real estate thing wasn't the best move for you. What's your take on people becoming investors around this time? People take it.
It's the best time. You know, you got to invest. It's some saying, you know, you got to more opportunity when there's blood in the streets. It's just like that's when the most opportunity is, when you have to go against the grain. Do opposite of what everybody else is doing. You know, when everybody's scared, you need to be brave. When everybody's brave, you need to be scared. You know, just like think about like the GameStop and AMC run. You know, everybody's excited. Everybody's investing in it. It's like, you need to go the other way. You know, if you see everybody doing one thing, do the opposite. You know, when you see the media and you see stuff on social media, the news, and they're talking about, hey, everybody's doing this.
Everybody's doing it.
That means you don't need to be doing it. You need to go do the opposite. So
do the opposite.
So when you see everybody pulling out of the market and they're saying, oh, I'm getting out, that's when you need to go in. You know, that's the perfect time to go in because everybody's afraid. But you just have to be educated and know how to buy right and saying, like, I'm going to buy a good deal. I have a plan. with every investment, I always say have an exit strategy.
Yeah.
Before you get into it, have a good exit strategy.
Yeah.
But you need to go in. So to speak on the markets, I mean, Florida. So I got a list of some of the overvalued cities in the country. So I'm just randomly: Boise City, Idaho, #1; Colorado Springs, 2; Vegas, 3; Phoenix, 4; Tampa, 5; Atlanta, 6. You got Fort Collins, Colorado. You got Fort Collins, you got Sherman, Texas, Jacksonville, and Charlotte. So of those cities, Atlanta and Charlotte are two of the cities that are overvalued, but they anticipate our cities, Charlotte and Atlanta, to continue to kind of keep a trend, and that's just because of the specific market conditions in Atlanta and Charlotte. And Florida is still pretty hot as well, because people still want to move to certain parts of Florida. It's a vacation spot. People like the tax situation there as well. So you're still seeing markets sustaining themselves and still pretty stable, even though you see overvalued homes and inflation. You're still seeing stability.
Hey, Trent. Hey, Trent.
Yeah.
Your audio, can you hear?
Yes. Yes. Can you hear me? Hello? Can you hear me?
Yeah. Can you hear me?
Yes, I can hear you. Can you hear me?
Yeah, your audio went out and came back in.
Yeah, my phone was ringing. Yeah.
Oh, your phone breaking up?
No, my phone, somebody was calling me. Can you hear me now?
Somebody was calling you on your phone. Okay, cool.
Yeah.
That's no problem.
You can hear me okay? Okay.
Okay, go ahead. Continue telling us.
Yeah, so I don't know if where it broke out, but yeah, so you're still seeing a lot of markets still sustaining themselves, even though they're overvalued. A lot of these markets are overvalued, but they're sustaining themselves because there's other factors at play. Like Atlanta, for example, you have a lot of industries moving to Atlanta. So when you're talking about, you got the movie industry, you have the tech industries, jobs are coming here. It supports the high prices, it supports the demand, and they have the salaries to pay higher interest on homes that they want, because they're comparing that to where they're coming from. People are moving here coming from markets like California and New York. So when they're moving here, they're seeing our market as a great deal. So it's inflated for people that are local and they've seen the past historical trend, but it's something new happening in certain cities. So like Atlanta, for example. So, it's pockets. You got to really look at hold on. Black one. Okay. Yeah, so it's pockets. It's pockets. So you got to kind of look at particular markets and kind of see what's going on, and figure out why things are the way they are. But yeah.
Okay. Sorry, right now.
Got a little bit of going in and out and coming back and forth, but this is not going to be long. But this is good stuff, man. It's really good stuff. The Atlanta market, a lot of people don't understand that the Atlanta market isn't like the rest of the markets. And I know a lot of people say it. I posted something today. I said Atlanta is in the top 5 growing markets in the country. Can you hear me?
Yep.
Okay. Top 5 growing markets in the country. That's huge. That's huge. So real estate, and I encourage people to understand, real estate is local. This is not when you see something on CNBC, this is not, hey, this is everybody and this is how everybody's going. No. Atlanta market is different. Utah's market is different. Charlotte's market is different. You've got to understand your current market so you know how to respond, how to react, how to pivot, and what to expect in that market, if I'm correct, right?
Yeah, absolutely. Absolutely.
Okay.
You got to study your market. Yeah. And I think the easiest way to do that is just, number one, if you're an agent or investor, you need to subscribe to new listings that hit the market. If you're an agent, then just subscribe yourself to anything in the area that you're working, and you want to see new listings as they hit the marketplace. You want to see that. So you can see where pricing's coming in at. You can start looking at days on market. You can see what stuff is actually selling for. And it just keeps you in tune with what's going on in your market of where you're trying to work. And then also, if you tap into the wholesaler market, if you're an investor, keeping track of that as well. Like when you see deals, kind of keep an eye on it and kind of gauge it based on what you've seen historically. And then you can start kind of making sense of it all. What are people doing? What's selling? What are people listing for? How long is it staying on the market before they do a price drop? Like, get an understanding of it, because when you see that, you're seeing in real time, how people are feeling, what the buyers are thinking, and then if you call agents and talk to listing agents, ask them about the action they're seeing, ask them about offers they're seeing, ask them about the terms of the offers they're seeing, where you're seeing more buyers putting in more contingencies. They're putting in seller contributions that they want now.
Yeah.
So they're being a little more, wanting to do amendment to address concerns after they do inspections.
We're seeing a lot more of that. Yeah.
Yeah, that wasn't the case just 6 months ago.
That wasn't the case 6 months ago. Not at all.
So when you're in tune, you can kind of know how to adjust. And I always say, man, when you're in this market, you're in this real estate game. It doesn't matter which way the market's going. We're in the business, So I don't care if it's going left, right, up, down. If you work the side that's works. So for example, like I tell agents too, if you see your residential sales aren't going the way you want them to, and the volume's not where you want it to be, start looking at other things. Like start working with investors. Investors usually are always buying. Like I know I do. Like I don't care which way the market's going. I'm not going to stop investing. I'm not going to stop doing something that we do. You're just going to do it a little differently. You might have different criteria that you set, but you're not going to stop doing business, or either you might change and try to diversify the asset types or the property types that you do. So if you're stuck doing single family, it's like, well, why don't you try to start looking at multifamily, look at quads, look at other things that investors might be interested in, look at maybe even start considering learning about commercial assets, retail, warehouse, strip mall type stuff. Like, look at other things, try to learn, continue to educate yourself, and continue to understand what's going on in your market.
Your very first multifamily, you've done multifamily deals before, right? Your very first multifamily deal, did you have help with it? Did you kind of say, hey, I can handle this? Or was it, how did that even come about? Like,
yeah, just cutting your teeth. I had a friend who was a broker at a brokerage that ended up taking on a property that the bank was selling, and it was basically foreclosing. And it was being offered at a pretty good deal. We were able to get first dibs on it because of the relationship with the broker. And we were able to come in and acquire the property with 20% down. Like, just say it was like, I think it was like $1 million, 52 units. They wanted 20% down, $200,000. So we got some partners, friends and family together and said, let's all put up some money, and we're able to acquire the property. We didn't know anything about multifamily. We just knew a little bit about single family. It was just cutting your teeth. Like, you gotta try. You gotta, sometimes you gotta say, I'm gonna put myself out there and do it. You gotta have a plan, but we didn't have all the know-how. So we hired property managers to come in, property management company to come in and kind of manage the whole property. And we didn't make any money for the first year because
the first year. Now that's say that again. The first year.
We didn't make any money. We didn't profit anything the first year. We just paid the bills,
Wow.
and paid the property managers and paid all the maintenance people. So we realized like something's not right. We should be making money. Yeah. So that's what got us into property management, actually, because we were like, let's take this over and manage it ourselves because we could probably do a better job, and we did. So
there's some crummy property managers out here.
Yeah,
some real crummy ones.
out of necessity, So we had to become property managers out of necessity, and then we kind of turned that into a line of business. Just understanding how to manage multifamily and how to manage the budget and how to manage, on-site managers and all that type stuff. So yeah,
man. Hey, we winding up to the end of this, and I thank you for sharing a lot. This is, I believe, if people don't know your story and how you came about in the space that you're at, can they kind of create an image in their mind of, hey, I can never do this because this person has XYZ amount of years, or this person has done this, he's been to school, got his master's, and all those different things, excuses that people typically give themselves when it comes to venturing into this space, being afraid to make the mistakes. And I know you are one of those people that you may not see your name all around, but you're there and you're making moves and you're doing great deals and you're building an empire. So as we look moving forward to this upcoming market, how things are adjusting, nobody has a crystal ball, but where would you say the opportunity lies for investors and agents in this? Where would you predict the opportunity lying for investors and agents moving forward in the next 6 to 12 months?
Probably, I would say, 2023, maybe into 2023, going into 2024. I feel like we're not going to see a ton of foreclosures or anything coming through like 2008, 2010. It's going to be an uptick in foreclosure. There's going to be, and I'm saying that because they're saying interest rates might still be at a high for the next 2 years.
So you said they're going to, you said, I hate to cut you off. You said that there may not be an uptake in foreclosures, but there'll be a slight uptake in foreclosures?
There won't be like a tsunami of foreclosures.
A tsunami, okay.
Back then, but because that's what some people are waiting on, the foreclosure tsunami. That's not going to happen. You're going to see an uptick, a slight uptick, where there might be some opportunities, but that's not going to be the base of it. It's going to be when the interest rates start coming back down, which they're predicting to be in the next couple of years. So 2022, 2023, once we start getting into 2024, you're probably going to start seeing interest rates coming back down. Then you're going to start seeing, more people entering back into the market, more people being active, people being willing to now sell their homes because they can go back and buy another home in a better interest rate environment. Nobody's trying to sell right now because they're not trying to go back and sell their home, and then their money is not going to take them as far as it would in a lower interest rate environment. So they're going to wait. So when you see, and honestly, you got to think about too, once this presidential administration is out of office, that's going to change things too. You know what I'm saying? Like once Biden's out of office and there's a new administration in place, you're going to see a lot of changes too. People are just going to think about the economy different. Who knows who's going to be the next president? Who knows, what the Fed is going to do with interest rates? But more than likely, they're slowing down all this hyperinflation with raising interest rates a bit to slow down, a lot of this crazy buying and everybody overpaying. They're slowing it down. And then it's going to take a couple of years to slow the train down. And then interest rates will come back down. And then people will start getting back into the market saying, okay, now I'm ready to sell my house. Now I'm ready to, move on, and I can go and buy something else and still get a decent interest rate. So that's how I'm predicting. If you're a conservative investor and you don't have a lot of resources, yeah, it's probably best to kind of sit on the sideline and don't do anything too risky. But if you're kind of like a value investor, you're always looking for deals. There's going to be deals out there. You just got to look. You got to keep looking. You got to look harder, but you can still find deals.
You can still find deals. Wholesalers, off market, things like that. But you predict that there are still deals out here now, and that we'll still be able to find deals and find probably more deals going into 2023, 2024, and so forth. Yep. And what's your favorite deal to find? What's your favorite creative deal to find that you're looking for, that you say, man, if I could get this, I enjoy this type of deal?
I mean, the best type of deals are helping distressed sellers, I think. Like I don't care if it's multifamily, single family, when you're helping a distressed seller, I consider that a win-win, right? So because that person is in a situation where they need help or they might lose it all. So when you can come in and you can get a discount and actually help them walk away with their credit intact and have some money in their pocket, they might not make as much as they want, and they might have to give up some of that equity in exchange for getting an exit out of their deal, but it will be more beneficial to them than losing everything to foreclosure or to, the bank taking everything back, or them, just being subject to bankruptcy or whatever they might have to do. When you can come in and save that seller or that owner and say like, hey, I'll take this off your hands. I'll buy this from you. You're not going to get market value. You're going to probably get 30% below market value, but it's saving the property. It's saving your credit, and it's putting some cash in your pocket versus it going back to the bank. So those are the favorite deals, is to be able to help distressed sellers, regardless of what kind of property they have. When you can help those distressed sellers, you're getting a great deal and you're helping somebody out of a situation.
Man, thanks for taking the time to jump on here and had this conversation. I had a little audio thing in my back, in the back of me, so I'm like trying to hear you. But I think we grabbed a lot of good content from you, and thanks for sharing it. I mean, you bring, man, almost 20 years of experience in what you do, and that's invaluable. You can't put a price tag on it, and I agree with you moving forward. Also in this market is going to be some great opportunities for investors and for agents also to posture themselves to help their clients and hopefully to get into the market themselves so they can actually build some wealth in that space. So, man, thanks for joining us at the Real Estate Lunchbox. And Trent, man, you're awesome. You know what I think about you already, man. You're awesome. Thanks for your time, and we're gonna wrap it up, man. Anything you want to say, Trent? Anything you want to add to this, real quick?
And just appreciate you having me on. And I just encourage anybody in the market, anybody in real estate, investor or your agent, just keep learning. Just keep learning, understanding what's going on, and have that thirst for knowledge. Because right now, so much is changing so quickly. So if you don't keep your ear to the street, it's gonna pass you by, or either you're gonna not understand what's happening when you're making certain decisions about your business or about your investment. So that's the main tip I would say I would leave everybody with, is just stay in tuned, keep learning. That you can never have enough credentials, or you can never have enough credibility. You can never learn enough. Always be learning. Always, never think of yourself so high where you can't learn from someone else. Always take in as much as you can. And you can filter it out as you learn, but take it as much as you can, keep learning, and keep paying attention to the market.
That's it. Taking as much as you can, keep learning, and keep paying attention to the market. Guys, if you want to get any more, some really good interviews, some really good data, please go to Real Estate Lunchbox on YouTube, subscribe to the channel. Also, you can check us out on Instagram. And if you definitely need to reach out to Trent, this is a guy you got to know. Trent, how can people find you?
You can reach out to me on LinkedIn under Trent Dunn. You can find me on LinkedIn. You can find me on Facebook. I'm not really on Instagram much, but yeah, you can find me on LinkedIn. Probably might be the best.
Might be the best. Very professional. Very professional.
Yeah.
Hey, Trent Dunn, Atlantica Properties. I pronounced it right. Atlantica Properties. Valued agent at EXP Realty. Hey, thanks, Trent, for joining us. And everybody, I hope this blesses you. I hope you guys gain something from this. And I will see you guys at the next Real Estate Lunchbox, where we can help you guys eat and make sure nobody swipes your lunch. All right.
All right, man. Thanks for having me.